It's Bogdan here from Systems Trader. Welcome to our second episode of the Holy Grail Trading Strategies of YouTube Debunk series. Today we will be testing another miraculous strategy promoted by a YouTuber. He claims this particular strategy is not being promoted by the sellers of online courses and other gurus because it actually works. To add to the fact that it actually works, you can use it on all time frames and all instruments. We have finally found the Holy Grail, we said. Unlike the previous strategy that was like a headless chicken, this guy is onto something. He figured out he needs a filter to decide on the direction of the trade and a trigger to enter the trade. So let's review his strategy. If the price is above the 200 period EMA, MACD is below zero, and then MACD crosses over the signal line, we go long. And the opposite holds true for short. So if the price is below the 200 period EMA, MACD is above zero, and MACD crosses under the signal line, then we go short. He goes on to tell us trading is a game of probability, and he usually takes 25% of the stake when the trade reaches a 1-to-1 risk to reward, but in general he's aiming for a 1.5-to-1 reward to risk. We will let you do the math of winning 25% of your stake on every trade with a win rate of 60%. Just let us know in the comment section how fast you can make $1 million. For simplicity, we will just set the take profit at 1.5 the risk. So in this case, we're going to take 30 pips and set the stop loss to 20 pips. He then starts off using his little Excel spreadsheet to run 100 trades on a 30 minutes bar period. We couldn't figure out if he started testing Euro-Yen and then switched to Euro-Dollar without clearing the initial results, but we definitely felt relief when he said we shouldn't worry because the strategy works on all time frames and all instruments anyway. At some point he says he ignored a few trades because they didn't look good enough. He's done this after accusing other gurus of cherry-picking trades. So let's look at the results. To spice things up a bit, let's look at the results of 2020. We've set slippage, commissions and spreads to zero at this point in time. Now we're gobsmacked. We figured we'll be able to break the strategy, but it seems to work. 119% return just in 2020? That's impressive, we said, and very much in line with what the guru was preaching all along. Look at the results. As we can see, we had 122 trades, a maximum drawdown of 20.8%, which is more than acceptable, and a total downtime of just 69%. Just to put things into perspective, trend following strategies have 70-80% total downtime. It's had a percentage of wins of 49.2%, and its annualized return was 119%. Standard deviation was 45.7%. Again, the standard deviation, for those of you that don't know, is a measure of risk, and the Sharpe ratio is at a whopping 2.6%. So were we wrong and he was right all along and we just ignored such a simple way of making money? Well, not so fast. Let's expand the testing period to maybe 10 years and have a look at Euro-Yen. This is when the bubble bursts. It seems that when we have over 1,000 trades, the results are no longer as impressive. So this is pretty much the reason why he switched from Euro-Yen to Euro-Dollar. On Euro-Yen, it's actually even worse. So let's now analyze the results on Euro-Dollar for the past 10 years. As we can see, the number of trades has increased to almost 1,800, which is roughly 3 a week. You can also notice we've still got the spread set to zero, and the percentage of winning has gone down to 40% roughly. So in his example, he's claiming he's got a 60% win rate, but in reality, when you're trading something that's trend following, your win rate won't be greater than 50% in any case. So because we've got a larger number of trades, the annual return has also gone down to 8%, and annualized risk is now close to 36%. So if you put things into perspective and check out the maximum drawdown, you'll see it's 95%, which means you would pretty much be able to lose 95% of your equity, and 96% of the time you would be underwater. One could say they're happy with an 8% year-on-year annualized return. But what will happen if we include spreads, commissions, and slippage? Let's run a test with them included and see if we stand a chance. So looking at the number of trades, in this case, we've got still 1,777 with the same win rate of 40.3%. If we check the spreads, we've only added 1.2 pips per trade. So that pretty much changes the annual return from plus 8% to minus 8%. What's also changed massively is the maximum drawdown, which is now minus 149.7%. So just to be clear what that means, it's a margin call. Your total downtime is 99%, so your equity would be underwater 99% of the time. So what's wrong with it? To start with, this is just another example of overfitting. 100 trades on a favorable time period is just irrelevant. Number 2, some trades are just skipped subjectively. A strategy is either traded or not. One cannot just place trades willy-nilly and claim there's a strategy behind it. Number 3, the exit logic, in this case with moving stop loss to break even, generally affects performance. Trends take time to unfold, and the money management in this case doesn't really make sense. Number 4, it is only traded on euro-dollar because it seems to perform better than euro-yen. So when our guy figured out euro-yen is not going to work, he just dismissed it. Number 5, claiming a strategy works on everything all the time is just ridiculous. There's no free lunch in trading. So what's good about it, one might ask? So our guy seems to understand the idea of using a filter to determine the market regime and a trigger to enter the trades. Can this strategy be improved? Maybe, maybe not. We've not spent any more time on optimizing it and running more tests, as there's many other ways to identify trends. Would we trade this? Absolutely not. In conclusion, overfitting any strategy can have some positive results, but that doesn't mean it will work in the long run. You need to be able a lot more than 100 trades to even consider you have discovered an inefficiency in the market and not just noise. Last but not least, the more you trade, the more cost of doing business you're going to have, so always keep that in mind. We at System Traders are a group of passionate developers and traders with a combined experience of over 10 years in the development of trading systems. Besides training our own strategies on our own portfolios, we're also developing bespoke strategies. Although it seems simple, building, testing, and running a strategy is not easy. The only way to be able to successfully run it is to know what to expect from it in the future. We can help you backtest, develop, and run your own strategy on stocks, forex, and futures. Feel free to get in touch for a quote on developing your system. We are happy to run a backtest for an indicator of your choice for free if you leave a comment with the name of the indicator, the instrument, and the lookback period. If you like this video, please give us a thumbs up and make sure to subscribe so that you can follow our series.